This isn't some future warning I'm giving you. This is literally happening to American families as we speak. Right now. Today. There are no dramatic foreclosure signs in yards, no CNN breaking news alerts, just families quietly drowning in their own homes, 1 month at a time, one bill at a time. Let me paint you a picture of what I mean. You walk through the doors of your local grocery store. Same place you've shopped at for forever. You grab the usual stuff, milk, eggs, bread, some chicken. Nothing wild, just the basics you need to feed your family. You load everything onto the conveyor belt and watch the numbers climb. The total pops up, $220. You literally freeze in place. Hold on a second. This exact same shopping trip cost you $150 not that long ago. You know this because you've been buying these identical items for years. So you swipe your card, bag everything up, walk to your car, and just sit there. Now, you're doing mental gymnastics, trying to figure out where the hell that extra $70 is supposed to come from. What do you cut out of your budget now? Your job's still there. Your paycheck didn't vanish into thin air. Nothing exploded in your life. But somehow, just existing costs more every single month. And here's the part that's driving people absolutely insane. You flip on the TV, and some economist is telling you everything's peachy. The economy's crushing it. Growth is solid. Employment's hanging in there. But when you look at your bank account, it's telling you a story that's completely at odds with what the so-called experts are saying. This is what I call the stable collapse. From the outside, everything appears totally normal. But inside people's homes, whole families are making brutal decisions every 30 days just to keep the lights on. By the time we're done here, you're going to understand exactly what's destroying regular people financially. Not some abstract economic theory or political talking points, just the cold, hard math that's crushing everyday Americans. And why that pressure in your chest is more legitimate than any cheerful headline wants to acknowledge. Because what's bearing down on us isn't your typical recession. It's the systematic elimination of middle-class existence as we knew it. The disappearing safety net. Let me explain something called financial margin. It's basically the space between being okay and being completely screwed. For decades, middle-class Americans had some of this buffer. Not a ton, but enough to handle life's curveballs. A car dies and needs $400 worth of repairs. It sucked, sure, but it didn't obliterate your entire financial life. Your kid needs new shoes? You just bought them. You weren't sitting there choosing between shoes and keeping the power on. That cushion made life manageable. Fast forward to today, that margin is completely gone. Wiped out. For tens of millions of families across this country. And here's what should terrify you. These aren't people who made terrible life choices. These are people with actual jobs who did everything society told them to do. Housing costs are consuming more of people's income than we've seen in generations. Doesn't matter if you're renting or if you own. You're hemorrhaging money either way. Rent climbed up and just stayed up there. If you purchased a home in the last few years, your mortgage payment is hundreds, sometimes over $1,000, more per month than it was in 2020. Same exact house. Completely different financial reality. Insurance turned into a legalized shakedown operation. Home insurance, assuming you can even find a company willing to cover you, has literally doubled in some states. Car insurance is up 30 to 50% across the board. Health insurance premiums keep climbing while covering progressively less of your actual medical expenses. And you can't just opt out of this stuff. The law forces you to have some of it. Basic survival demands the rest. Medical costs are a complete nightmare. Even when you have insurance, one emergency room visit can cost you thousands out of pocket. Prescription medications that were $40 are now $200. Those supposedly covered annual checkups somehow come with mystery charges nobody explained to you. Then there's all the small stuff that adds up to real money. Internet and phone bills you can't live without. Streaming services that went from luxury to essential. Gas prices that never returned to what they used to be. Your fixed costs, the stuff you absolutely cannot avoid paying, are eating up way more of your money than they did before. And when those fixed costs expand, your breathing room evaporates. Here's what that actually looks like in practice. A bill that mildly annoyed you 2 years ago now forces you to make impossible choices. Do you pay your electric bill in full or make the credit card minimum payment? Do you fill up your gas tank or buy enough groceries? Do you take your kid to the doctor or wait it out and pray whatever it is gets better on its own? These aren't theoretical scenarios I'm making up. Millions of people are making these exact decisions every single day. It happens so quietly, like water slowly rising in a locked room. You push off the oil change. You rotate which bills get paid on time and which ones don't. You use one credit card to make the payment on another credit card. You start saying maybe instead of yes to your kids. Tiny adjustments, survival tactics, happening in millions of homes at the exact same time. And the psychological damage this causes? People genuinely think it's just them. Everyone else looks fine from the outside, so they turn that blame inward. Maybe I'm not working hard enough. Maybe I screwed up somewhere. Maybe I'm just terrible with money. But that's not what happened. You didn't change. Everything around you changed. This is erosion in slow motion. Your financial foundation is crumbling so gradually that by the time you realize how deep the damage goes, you're already teetering on the edge. And here's the truth nobody in power wants to acknowledge. You're not imagining any of this. This pressure is real. It's systemic. And it's hammering families who did everything right, but are still one surprise expense away from total collapse. The debt death spiral. Now here's where this situation gets really dark. When your breathing room disappears, people don't just stop living. They can't. Bills don't hit pause because you're struggling. Kids still need to eat. The lights still need to stay on. So people turn to the only option left: debt. But debt in America has transformed into something genuinely sinister. It used to be a tool for building a better future. Mortgages bought homes that gained value over time. Car loans were for vehicles that lasted a decade or more. Credit cards handled major purchases that you paid off over a few months. Strategic. Purposeful. But here's the fundamental shift that's destroying people. Debt used to come after you achieved some stability. You got the raise. Then you upgraded your life accordingly. That's completely flipped now. Costs hit you first. Your income can't keep pace. Debt becomes the thing that fills the gap between basic survival and complete financial collapse. Credit cards are the clearest example of this transformation. They used to be convenient. You bought something. You paid it off every month. Simple and straightforward. And today, they're life support systems. Groceries cost $40 more than you budgeted for. The card covers the difference. Insurance jumps $50 without any warning. The card absorbs the hit. You have a $200 copay, but only $73 in your checking account. Goes on the card. Not because you're financially irresponsible, because these are unavoidable expenses, and there's literally nowhere else for that money to come from. Your paycheck is already allocated before you even see it. Rent, car payment, utilities, student loans, non-negotiables. This dynamic is particularly devastating for middle-class families. They make too much money to qualify for government assistance. They don't make enough money to actually be comfortable. Stuck in this brutal middle zone where they're too wealthy for help, but too broke to breathe. Over the past few years, these families burned through everything. Emergency savings, money they'd set aside for a down payment, college savings for their kids, gone, spent, vanished into the void. And what replaced those savings wasn't a promotion or a raise. It was growing credit card balances carrying interest rates over 20%. Here's why this is absolutely catastrophic. Once debt becomes woven into your monthly survival, once you need it just to make it through a normal month, you lose all flexibility. Every dollar is spoken for before it hits your account. Some goes to this month's expenses. Some goes to paying interest on last month's expenses, and the month before that, and the month before that. Your budget stops being something you control. It becomes a cage. With zero flexibility, tiny mistakes become catastrophic disasters. One late payment? Fee. That fee pushes you closer to your limit. Next month becomes harder, then harder still. The cycle accelerates, feeds on itself. This is why debt today feels fundamentally different from debt in the past. It's not financing boats or vacation homes or risky investments. It's covering basic survival, Groceries, medical bills, car repairs, insurance, things you literally cannot stop paying for without your entire life falling apart. And financial systems built on margins this thin don't explode overnight. They don't give you clear warnings. They just strain quietly, month after month, until one small thing tips everything over the edge. The warning lights are flashing. What does it actually look like when families completely run out of room? When there's nowhere left to cut? Delinquencies. And the numbers should scare you. A delinquency means you're late on a payment. You missed the credit card due date. Your car payment is 30 days overdue. But here's what that missed payment actually represents. By the time someone hits delinquency, every other desperate measure has already failed. They cut spending everywhere humanly possible. They drained their savings accounts. They maxed out their credit. They made every painful adjustment they could think of. The delinquency isn't the first problem. It's the first visible crack in a foundation that's been crumbling for months. Most people follow the same pattern when money gets tight. Housing gets protected first. Nobody wants to face eviction or foreclosure. So rent and mortgage payments get defended at all costs. Utilities come next. You need electricity and running water. Food is non-negotiable. But what gets sacrificed? The flexible obligations, credit card payments, personal loans, sometimes even car payments. These aren't casual decisions people make while watching TV. This is someone at 3 in the morning with a calculator, running impossible math over and over again, desperately trying to make reality fit inside their paycheck. Finally, painfully, deciding that something has to break. Here's what should genuinely scare you. Delinquency rates are climbing across every major type of debt. Credit cards, auto loans, personal loans, all of them showing more and more people falling behind. Not because Americans suddenly became reckless idiots, but because people across all income levels are simultaneously hitting the edge of what's survivable. And this changes everything. It's not just hitting poor people anymore, and middle-income families, people working full-time jobs, families making $50,000 to $70,000 a year, households that should be stable by any reasonable measure. They're increasingly part of this wave. That's not a red flag. That's a 5-alarm fire. When delinquencies only hit low-income households, the financial system can absorb it. It's expected, accounted for. But when delinquencies start spreading across income levels, showing up in supposedly stable households, that's a completely different signal. The financial foundation holding up regular American life is way weaker than anyone in power wants to admit. Historically, this exact pattern shows up right before bigger economic problems become impossible to ignore. Jobs still look stable on paper. People are still working. Spending continues, though way more carefully than before. But underneath that normal-looking surface, the foundation is cracking. Delinquencies aren't the crisis itself. They're the warning system. Smoke before the visible fire. They're telling you that millions of households aren't operating from comfort or even basic stability. They're in constant, exhausting triage mode. Every single month is a brutal decision about which bills get paid and which ones don't. And when millions of people enter survival mode simultaneously, the effects don't stay contained. They spread, slowly at first, quietly, like cracks spreading through concrete. The DP lie. Here's what's driving people to the breaking point mentally. You're struggling. You know it intimately. You feel it every single day. But you turn on the TV and financial analysts are celebrating. The economy's growing strong. People are spending money. Our GDP is up another quarter. What the hell is going on? The data lying? Are you losing your mind? The answer is more disturbing than either option. The economy can be growing officially while regular people are drowning financially. Both can be absolutely true at the exact same time. Here's why this happens. GDP measures money moving. Activity, transactions, how much stuff gets bought, made, and spent. But here's the fatal flaw in this measurement. It doesn't track where that money is coming from or whether the spending is sustainable. Concrete example, you buy a $200 dinner using money from your paycheck. That shows up in GDP as $200 of economic activity. Good, healthy spending. You buy the exact same dinner using a credit card you can't actually pay off, carrying 22% interest. still shows up as $200 of economic activity. And identical to the first scenario, still looks good. The CCB can't tell the difference between these two situations. Doesn't even try. Over the past few years, consumer spending, which makes up 70% of GDP, has been increasingly fueled by credit and depleted savings, not rising incomes. People spent their pandemic savings. They leaned harder on credit cards. They took on more debt to maintain their lifestyles. Every single dollar of that debt-fueled spending showed up as economic growth, while the underlying foundation rotted away. This is why you see packed restaurants and busy stores while people are quietly suffocating financially. You see spending happening everywhere. Businesses look busy. You think to yourself, maybe it really is just me. But you can't see how many of those purchases went on credit cards that won't get paid off. Can't see whether people are spending comfortably or desperately squeezing every expense from budgets that are already bleeding. Those details are invisible. They don't appear in the headlines. Here's what JPMorgan completely misses. What money goes toward has fundamentally changed. More money now goes to basics that don't actually improve your life. You're paying more for housing, but you're not living somewhere nicer. Paying more for insurance, but you don't have better coverage. Paying more for healthcare, but you're not any healthier. Just costs that rose and locked in at higher levels. So even if you got a small raise, even if you're technically earning more, that entire increase went to covering the higher basics. You're not advancing. You're not building anything. You're running faster just to stay in the same place. Or running faster while still falling behind. Eventually, the math stops working. Credit cards max out. Minimum payments become impossible to make. Lenders see people struggling and tighten their standards. The spending that is supporting GDP starts to fade. Not because people don't want to buy things, but because the financial structure holding up that spending collapses. This is why GDP is a lagging indicator. It doesn't warn you that trouble is coming. It just confirms what already happened. By the time GDP clearly shows weakness, households have usually been suffering for months or even years. So when you hear someone talking about a strong economy, force yourself to ask, strong for whom? By what measure? In what way? Because overall statistics hide individual disasters. And right now, a massive disaster is hiding underneath good-looking headlines. The economy isn't fine. It's just moving. There's a critical difference. Millions of people are learning it the hard way. The inflation trap, one of the most frustrating aspects of what's happening. You keep hearing that inflation is under control. Back to normal. Crisis over. And technically, that's true. The rate at which prices are rising has slowed down from 2022's peak. But here's the critical problem that nobody explains properly. Slower price increases don't mean lower prices. Not even close to the same thing. Inflation coming down doesn't mean things got cheaper. It means they're still getting more expensive, just slower than before. You're still paying more, just not as fast. Mountain climbing analogy. First, you're ascending a brutal, steep slope. Fast, exhausting. Oh, that's high inflation? Then the terrain levels out. You're still climbing, still ascending, just not as steep anymore. That's lower inflation, sir, but you're still way higher up the mountain than when you started. Your elevation didn't decrease. You didn't descend. You're just not climbing as aggressively. That's exactly what happened to prices. They shot up dramatically. Then they stabilized. But they stabilized at the new higher level. They did not return to where they were before. Your weekly groceries were $120 in 2021. In 2022, they spiked to $170. Now in 2025, they're still around $180. They're not jumping as hard, but they're absolutely not returning to $120. Insurance went crazy, stayed high. Healthcare costs jumped, stayed there. Gas surged, dropped slightly, settled way higher than pre-pandemic levels. Oh, for families trying to budget and survive, this is absolutely brutal. Because what matters isn't the rate of change that economists celebrate on TV, it's the actual price. The real number on your receipt, the literal dollars leaving your bank account. Those numbers reset higher and locked in at those levels. This completely reshaped monthly budgets for millions of families. Money that used to have some flexibility, that gave you options, is now completely locked into covering these new baseline costs. What was manageable became tight. What was tight became impossible. And it gets worse. While prices stayed high, interest rates also stayed high. Rates were raised to fight inflation. And in some ways, it worked. Inflation did drop from its peak. But those high interest rates didn't disappear once inflation calmed down. They stuck around. And the longer they stayed elevated, the more they shifted from a temporary shock to a permanent feature of daily life. Carrying any credit card balance? You're paying way more in interest now. Average rates are over 20%. If you're carrying $5,000 in credit card debt, you're paying over $1,000 per year purely in interest. Money that's doing absolutely nothing except servicing old debt. Car loans got ridiculously expensive. Bought a car recently? Your monthly payment is probably $100 to $200 higher than it would have been in 2020 for the exact same car, just from the interest rate difference alone. This combination, high prices staying high plus high interest rates staying high, makes right now feel fundamentally different than past inflation scares. Normally, when prices spike temporarily and then retreat, households can recover. They tighten their belts briefly, ride it out, return to normal when things ease up. But when prices spike and lock in while borrowing costs stay elevated, the pressure becomes structural, not temporary. It doesn't ease with time. It demands permanent changes to how you live. For millions of people, that brutal adjustment already happened. They changed how they shop, cut out restaurants completely, canceled every subscription they could, put off purchases they wouldn't have questioned a few years ago. But what they couldn't adjust? The fixed costs. Rent, insurance, loan payments, utilities. Those stayed locked at their new higher levels. This is why the squeeze feels persistent and inescapable. It's not tied to one event or one year. It's built into the basic structure of daily life now. Every month starts you closer to the edge than the last one did. When old bills come back to haunt you, something made this entire situation catastrophically worse, pushed millions of people from struggling to drowning. For many families, the real pressure didn't come from new debt or bad financial decisions. It came from old obligations returning at exactly the worst possible time. Student loans are the clearest, most brutal example of this. During the pandemic, federal student loan payments were completely paused, stopped entirely. For millions of people, that monthly payment vanished for over 2 years. During that pause, people adjusted their entire lives. Life reorganized around not having that payment. Budgets shifted. Other expenses expanded to fill that space. Rent went up. People handled it because they didn't have student loans. Their car insurance jumped, felt manageable with that extra breathing room. Other costs crept higher but seemed survivable with that additional margin. People restructured their entire financial lives around what they thought was relief. But it was temporary relief. Borrowed time. Then, student loans came back, not as a fresh expense, as a brutal wake-up call that the breathing room people thought they'd gained was never actually real. For some people, the amount wasn't even massive. $200 monthly. Maybe $300. But when your budget's already operating at maximum capacity, when you're already making painful choices just to keep the lights on, adding back even $200 forces something else to catastrophically break. And here's the sneaky part. The pressure from resumed student loan payments doesn't always show up in student loan delinquency numbers. And it shows up everywhere else. In credit card balances that suddenly start climbing again. Savings accounts that get totally drained. Other bills that get paid late or not at all because that money had to go to student loans to avoid default. The pressure spreads like poison through people's entire budgets. Car loans followed the exact same brutal pattern. Car prices exploded. New cars became wildly expensive. Used cars, which are usually the affordable option, also shot up in price. Simultaneously, interest rates surged. Need a car? Which most Americans absolutely do for work? You're looking at payments that are hundreds of dollars higher per month than just a few years ago for identical transportation. And car ownership isn't optional for most people. You need it for your job? That payment becomes fixed, mandatory, a part of your budget, whether you can afford it or not. What makes this combination catastrophically dangerous isn't any single payment in isolation. It's how they stack, how they pile up on top of each other. Student loan comes back here. Way higher car payment there. Insurance rising relentlessly in the background. Rent or mortgage staying high. Healthcare costs appearing unpredictably. None of these alone would destroy a household, but together, layered on top of each other, they squeeze budgets until there's literally zero flexibility remaining. This is how pressure spreads invisibly through the system. A bill isn't paid late because it doesn't matter. It's paid late because three other things took absolute priority and there wasn't enough money left for everything. Yet this explains the most confusing contradiction people are experiencing. How can families be struggling this badly when people still have jobs? The answer? People are working, getting paychecks, but they're also carrying way more financial obligations than their income can realistically handle. Jobs didn't vanish. Paychecks didn't stop coming. The crushing weight of obligations just became too much for income to support. Why it keeps getting worse, people keep asking, if these problems started years ago, why does everything feel like it's getting worse now instead of better? The lag effect. And understanding this concept shows we're probably not at the end of this. We might still be in the early stages. Economic changes and rising costs don't hit everyone instantly. When interest rates rise and costs surge, the damage spreads slowly through the system. It hits different people at different times depending on their specific situations. Early on, most people have buffers. Protection. You might have a fixed-rate mortgage locked in years ago. Your house payment doesn't change when rates go crazy. You might have built up savings during better times. You can absorb cost increases without immediately changing your life. You have available credit. You can smooth over rough patches temporarily. For months, maybe over a year, life feels uncomfortable but manageable, stressful but survivable. This is why it initially looked like the economy could handle higher rates and costs without suffering major damage. People were adjusting, adapting, but not visibly breaking. But buffers don't last forever. They run out. As time passes, that protection systematically disappears. Savings drain, covering the growing gap between income and spending. Credit cards hit their limits. Old car loans get paid off, and you need another car. But the new loan comes with payments that are hundreds of dollars higher because of current interest rates. Each month, more households cross that invisible line from stressed but managing to can't handle even one more hit. That's when the lag effect becomes visible. Not through dramatic headlines, but through behavior changes. People stop planning big purchases. They hesitate before making any new financial commitment. They get cautious, not from pessimism, but because painful experience taught them their margin is way thinner than they thought. One unexpected problem now could tip everything into disaster. Businesses sense this shift. Oh, they get conservative, delay expansion plans, slow down hiring, watch their customers more carefully, noticing that people are still spending, but way more carefully, fearfully. This is why economies can look solid, even healthy, for long periods, and then suddenly feel fragile. The damage isn't instant. It's cumulative. It builds. Each month of tight conditions adds more strain to already stretched households. Eventually, the system hits a point where even small shocks matter enormously. A car repair that was annoying but manageable 2 years ago now requires agonizing financial decisions. A medical bill that would have come straight from savings now goes on a credit card at 22% interest. A job loss that would have meant careful budgeting now means immediate disaster. By the time the lag effect fully shows itself, modern households have already adapted in quiet, invisible ways. They've fundamentally changed how they live, lowered their expectations, accepted this diminished reality as normal without consciously realizing the transformation happened. That's what makes this phase sneaky and hard to recognize. The adjustment happens gradually enough that you don't see it happening until you deliberately compare your life now to 3 years ago. Then the difference is shocking. How much tighter everything has become. How much less secure you feel. How much smaller your world got. But there's no quick fix for this. No way to undo years of erosion in 1 month. The pressure doesn't explode dramatically. It settles in, becomes the new normal you're living in. This is the lag effect in action. It's why problems from 2022 are still being felt, and maybe even more intensely in 2025. The initial shock happened years ago, but we're still living through the rippling consequences. And for many households, the worst impacts are only hitting right now. The slow death nobody sees coming. What happens next? What does the future actually look like from here? Most people expect clear, defining moments. A recession gets officially declared. The stock market crashes. Some dramatic event where everything obviously breaks at once. But that's not how this usually goes. What's way more likely, what we're probably already seeing, is the slow collapse. It doesn't look like a traditional crisis. It looks like exhaustion. The economy's still technically moving and nominally functioning, but with progressively less energy, less confidence, less momentum. Consumer spending doesn't collapse overnight in some dramatic fashion. It weakens gradually, little by little, month by month. People keep buying absolute necessities: food, gas, utilities, the basics. Those continue because they must. Survival demands them, but everything else gets systematically cut. Restaurant dinners become cooking at home. Weekend trips get canceled indefinitely. New clothes get delayed or abandoned completely. Car upgrades get pushed years into the future. Small luxuries that made life bearable just disappear. None of these individual cuts seem significant when looked at alone. But when millions of people make identical decisions simultaneously, the total impact ripples through the entire economy. Businesses notice, not through panic or sudden collapse, through progressively softer demand. A slower inventory turnover, customers still showing up but buying less, choosing cheaper options, trading down. It's subtle initially, easy to dismiss as temporary, but it continues, month after month, quarter after quarter. This leads to businesses getting way more conservative. Hiring gets cautious. Companies fill open positions way slower or decide to just operate with their current staff. They postpone expansion plans, scrutinize every dollar they spend. Layoffs might happen, not in massive waves that create national panic,